Stocks may be ripping through June with the S&P 500 up 5%, but our next guest says if you try and chase this rally, look out below. Let's go off the charts with Jason Hunter, JPMorgan, head of global fixed income and U.S. equity technical strategy. He's over at the Plasma. Jason, what are you looking at?
Oh, yeah. Hey, thanks for having me. So let's start with the broad S&P view. So it's a little bit of a good news, bad news situation when we look at the chart. So we'll start with what's happened. So one, the market traded in this broad pattern that it broke down from in late May, which has pretty bearish implications, particularly if you look at the way a lot of the trend following signals were set at that point in time, a number of moving averages. The market broke down through those at a time where the news story wasn't looking that good, which really could have generated a lot of downside momentum. So one, on the good news front, the fact that the bears weren't able to do a heck of a lot with that, despite the news headlines after the breakdown, and then subsequent move that we've had, 5-day sharp rally, taking the market right back through that important 2800 inflection above the 200-day moving average again. The fact that you put it back in the pattern, normally that would be associated with a good medium-term outlook. It suggests there isn't a lot of weak hands that are ready to panic out of the market. A strong, long that you're seeing in the S&P, and you could generate bullish momentum on that. Now, on the flip side of that, you're already back to the 2900 area. Our base case view all along on the technical side for JPMorgan was thinking that 2950, 3000 probably caps the market going into the third quarter. And we're getting in close proximity to that. And most important, this has been a very headline-driven market over the past several months. We have G20 heading, coming up. The trade stories in focus, very much of what's already been talked about on the show. So with the market near 2900 and a number of the cyclically sensitive groups not really performing all that well just yet, things like copper, semiconductors, we're less inclined to try and chase the market up here. And we want to see basically the market, trade well for a few weeks before we look at that. So to focus more on cyclically sensitive groups, we're looking at the semiconductor index, the SOX index. It came down in virtual straight line, a gap-filled decline as the trade headlines started to turn negative. Yes, we've bounced off of key support, but there's no clear base pattern to post up against as a technician to say for sure that this is bottom. This could still be a bear market bounce for semis, and going into G20, for obvious reasons, you want to watch and see how the headlines hit before you, try and even touch this group. So what we'll watch as we move over the next several weeks is, one, is the S&P going to consolidate and hold above the 2,800 level again? Two, watching, copper, crude, semiconductors, seeing if those can start to outperform over that period, and likely that's going to be headline driven. If those things all fall into place, then maybe we have to move our objectives up for the S&P. Maybe 3,000 is too conservative for the index. On the flip side, if the headlines go south, one of the things we look at is year-on-year growth for semiconductors. This particular index tends to line up well with global PMI. Global PMI is sitting just above 50 right now on the manufacturing side. To fully reprice semis for that 50 type number, there's still a lot of weakness that can happen here. So we want to wait and see here right now and see how things shape up.
Mm-hmm. Concerns about the 10-year yield, Jason, had been a damper for the markets last month, and you're the perfect person to ask because you do technical strategy and you're the head of global fixed income. So where do you see the 10-year yield going, and what do you think this yield is telling us in terms of, is it being driven by forecasts for the economy or forecasts for inflation? What's the key driver here?
So we'll start with over the near term. We have a number of systematic strategies that we built that help us navigate pivot points for the Treasury market. And the last time I was on the show, the market was trending strongly to lower yields. We were saying don't stand in front of it yet. We're not in the zone for a number of those indicators before they're set to fire sell signals. A couple of those sell signals have actually triggered over the last week or so. So tactically, we're actually in a bearish 10-year note position right now. And as you said, that's been a cushion for the market. For the first 3 days of that S&P recovery rally, it was defensive groups like utilities, consumer staples that really benefited from the drop in yields and helped lift the S&P 500. Our view over the near term is now that the 10-year yield stabilizes over the short term. Maybe you get some backing and filling toward 225, 230. But that 230 level is now a big inflection. That's where yields tried to base out in March and again in May. They couldn't hold it, and then they sharply dropped to lower levels. That's probably, you're going to find a lot of Treasury buyers on a retracement toward that level now. As the expectations of are the trade story that's already in the market, does that start to work its way into the economy? Individuals that were bearish on rates going into that maybe started to flip a little bit, looking for opportunities to buy. You're probably going to get a little bit of that as we back up toward the 225 area.
All right, Jason, great to have you with us. Thank you.
Thank you.
Jason Hunter of JPMorgan. Dan.
Seems like a lot of people just want to talk about rates right here. In the 10-year, that 2% was a kind of a level here. And I got to tell you, if it breaks below there for the wrong reasons, I think you're going to see alarm bells go off on risk assets all over the globe here. Because when you think about how much sovereign debt outside the U.S. is in negative territory, and what that means for their economies. You know, just today, you interviewing Larry Kudlow today, he was talking about Europe. He was talking about, you know, the problems they have and how slow they have been to kind of stoke inflation, that sort of thing. If we get to a point where we are this far into the recovery, you know, 10 years on, I got to tell you, rates going back in that direction will not be good for the stock market.
So what I'm wondering right now is how much of this rally has been a head fake. I mean, there's just so many risk-off signals I'm seeing right now. You've got gold outperforming copper. You've got the staples outperforming discretionary. Defensive sectors are leading. Personally, I think we're at a spot right now where the market's going to trade range-bound and sideways for the rest of the year unless and until we actually get a trade deal.
And you're cautious.
I am. I mean, this is about as cautious as I get from me. I'm always long, but I am really concerned. I think the Fed's in a bit of a box. I think that the market is already pricing in some movement of the Fed down and a likelihood of the trade deal that I don't know. I don't know how you can be that comfortable.
I would say, and Karen hit it at the very top of the show, and it's exactly what I would say. I think you can still own this market. You got to buy that put protection that gives you that ability to feel very comfortable about it, Mel. But that gives you all that room to be able to make these trades to the upside as we're doing, regardless of what the reasoning is behind why the market is moving to the upside and whatever the different rotations are that are moving us to the upside. That's been very strong. And because of that, I think there are opportunities. Every single day we see opportunities in stocks that I think are created by getting oversold. We've seen it out of Apple. We've seen it out of Facebook. We've seen it out of multiple names. And those opportunities are there. And when they are, you can buy that protection right now as cheap as it's been in terms of that 15 to call it 21, if we even get as much as 21, because we haven't been able to break through 20 in quite a while.